Hello and welcome. You're watching News 9 Live. I am Shweta Kothari. The Nifty 50 index crossed the 25,000 mark for the first time today. The index opened at about 25,030 on Thursday and settled at 25,010 mark. The Nifty has taken just 24 sessions to cross 1,000 points from 24,000 to 25,000. Now, Nifty 50 index crossed the 24,000 mark on June 24th. This is the fastest 1,000 point rally of Nifty 50. The BSE's 30-share Sensex also crossed 82,000 mark for the first time in the morning trade session today, but settled at 81,867. The fresh impetus was provided by the US Federal Reserve's meeting outcome that enthused global markets, including Indian markets. And the US Federal Reserve indicated, remember, that they may start cutting interest rates from September onward, leading to a rally in the global markets. The reduction in interest rates will ease concerns of global slowdown and propel growth for a lot of developing and growing economies, including that of India. What does it really mean for India, and how do markets go on from here? Let's talk about that. Joining us is Sudeep Bandyopadhyay, is the Group Chairman, Indie Trade Capital. Also with us is Avinash Gorakshakar, is the Director, Research, Profit Mart Securities. On the show is Akshay Bhagwat, Senior VP, Derivatives Research, JM Financials. With me is Suyash Maheshwari. I'll come to you first, Suyash. Run our viewers through all the markets action today.
Certainly, Shweta, and a historic day for our markets. Nifty for the very first time has moved past the 25,000 milestone. And I mean, on Monday, we did make an attempt towards it. Nifty got to about 24,999.75 levels. So just about 25 basis points short. So it was only a matter of time before we got to that psychological level of 25,000. But, just a word, it is the third fastest 1,000 point rally. But for some context, viewers need to understand that when Nifty made its first 1,000 point move from 1,000 to 2,000, it essentially had to double or rise by about 100%. But a move from 24,000 to 25,000 only requires a movement of about 4.16%. So while it may look like that this rally or this move has been very strong in absolute terms, in percentage terms, it's more really digestible. Now, talking about what led to this rally, you also pointed out that it was a dovish commentary that came from the US Federal Reserve. And just to be sure, US Federal Reserve did not cut interest rates, and they maintained it for the 8th consecutive time. But Fed chair has made a dovish pivot. He has indicated that rate cuts could happen soon, and as soon as September, and potentially we could have a second rate cut as well in the US in December also. He also said that the risk of unemployment is now at par with the risk of inflation. And as for inflation, according to Mr. Jerome Powell, it's coming down nicely. It's getting closer to their target of about 2%. So that overall created a risk on sentiment for investors. And we saw a fall in dollar index, and we also saw a fall in the bond yields. And when both of these, the dollar index and the bond yields, go down, it's a good news for emerging markets like India, and that provided that much needed final nudge. But let's not forget, Indian markets have been rallying for about the better part of 2 months now, or at least since June 4th, when the election day outcome came out. Nifty, for that matter, has rallied about 3,100 points, Shweta. So a massive rally we have seen post elections. Of course, that was a big binary event that the market was waiting for. Once that got out of the way, we saw some bit of a correction on the budget day itself, but nothing major, no major correction as such, no 1% up move or down move. So the ride has been sharp, but it has been a steady ride.
Okay, a sharp ride, a steady ride on the back of strong fundamentals as far as India is concerned, but also global cues that are propelling not just Indian market, but also markets in Asia. So I want to come to you first. Your first commentary on Nifty crossing that brilliant 25,000 mark, and what are you making of this movement? Is it likely to sustain?
Well, first of all, I think it's a historical event. And, we are pretty blessed to be witnessing this fantastic rally, no doubt about it. Multiple factors, including, as Suyash was mentioning, it was on the back of the fact that US Fed very clearly indicated, Fed chair, that there is one cut coming in September and maybe one in December. So this was a kind of a change of policy stance and an excitement in the market, both US as well as other emerging markets, was expected. So today's rally was on expected lines. But I think we scratch the surface and look at what is causing this upsurge in the index in India or upward movement of capital market. I would say it can be ascribed to maybe 1, 2, 3 factors, whatever number of factors we may call. And all of them are liquidity, liquidity, and liquidity. I think it's on the back of strong domestic liquidity support, which is what is taking the markets higher and higher and higher. Of course, the macro factors are good. Corporate results have been by and large in line, and in some cases better. But I think monsoon has been good. But I think the fundamental factor which is taking the market, propelling the index upwards is the domestic liquidity. You take from January to June, I haven't seen the July numbers yet. If you take this entire 6-month period, the FIIs have been net investment have been almost zero. So they have sold, they have bought, and net is zero. And in this period, January to June, I think the Indian markets took a quantum leap, and it's on the back of domestic liquidity. Every month, 22,000 is coming by way of SIP. Another 25,000 crore is coming either directly or through PMS or other means. So about 60,000 crores of incremental liquidity is coming to the market, and that's ensuring that the market keeps moving up.
All right, and just to take cues from what Mr. Bandyopadhyay was saying, Avinash, I'll come to you on this. This rally, of course, as Mr. Bandyopadhyay was mentioning, has been driven by liquidity and more importantly, domestic liquidity, because FIIs have been pretty much absent for the better part of 2 years. But do you think that makes it a bit suspect, because this money or this boom that we are seeing in markets is also not just driven by DIIs, but also your retail participants, which are considered typically weak hands in the financial markets? Do you think that makes this rally a bit suspect?
Avinash is not on the show. Let's take that question to Sudeep.
Well, I don't think, we can call the retail hands weak anymore. Suhash, predominantly the flow is coming through the asset managers, which is the mutual funds, PMS, and alternate funds. Now, they have a very clear strategy. They believe in India, and if they divest from a particular stock, they are putting money in some other stock. So it is not weak hand of individual investors any longer. Yes, money is coming from retail directly as well, but I think a large chunk of this is coming through the institutional route via mutual funds, PMS, AIF, and others. Second, a lot of HNI money is coming in. Again, they are not weak hands. And finally, I would say that there has been a continuous rally. The market has been moving up and up and up. Yeah, there are in between, as you rightly said, the election result day 4th June is a dip. There was some dip before that also a couple of months back. But these dips are being considered as opportunity for acquiring further stocks. People are waiting for the dips to come so that they can acquire more of stocks. So this financialization of savings, which is happening in India, and that's real. And that is leading to this rally. Banks are crippling. They're not getting deposits. CASA is drying. But the fact is, money is coming to the markets, financial markets, particularly the capital markets, directly or indirectly.
All right, and that is coming by the way of liquidity we are seeing. And as far as DIIs, which continue to be net buyers, while FIIs are buying and selling in equal proportion. Now, there is, Avinash is, I think, with us on the show. Avinash, there is a feeling that if, both FIIs, DIIs were turn net buyers tomorrow, markets will spurt. But sustaining the rally as it is today looks difficult. With valuations already stretched, what is your view of where the markets are headed? And as far as retail participants is concerned, who are waiting on the sidelines, should they be investing right now? Is the market too heated? Avinash? All right, I think we've lost Avinash, but while we are on markets, let's also, talk about the support levels. And we have Akshay with us on the show. Akshay, there is a sense that the short-term perspective is that the rally will continue as far as Nifty is concerned, perhaps touch about 25,330 to 530. What are the support levels that you're looking at? You'll need to unmute yourself, Akshay.
Yeah. Good evening, Shweta. Well, see, it's been a rally which is unstoppable as I see. If you were to see the trading parameters on the price charts, it is trading in an overbought zone, but really there is no still sign of any major reversal or correction. If you were to look at the support zones based on the last 4 days of price action, 24,750 is a vital support zone for the market. It is kind of languishing around the 25,000 pivotal level. We have touched and conquered a landmark level today. That's the 25,000 mark. But really, from here, does the momentum rally continue one way as it has been in the past? That's a question for me, because I believe that in the month of August, which is a pretty long expiry on the derivative series, there is a good chance that a time correction would unfold in the Nifty index, where Nifty might be confined in a range which I see 24,500 on the lower end and probably maybe 25,200 on the upper end. But I do not see any major rally from here on, at least for the month of August. It will be more of a range bound, time consuming price action. It will be choppy in between. It will be stable though. So for levels 24750, that's the first level of support I see in the market. Beyond that, if in case it were to break going ahead, 24,500 comes into the picture. And on the upside, as of now, 25,200 is crucial resistance for the Nifty index.
All right, those are the support and resistance levels for Nifty. But, Akshay, we have long spoken about how Bank Nifty has been a laggard in this market. And that's a big pocket for the market. 35% of Nifty's weightage comes via banks. And it continues to underperform. We have spoken about it at length. When will Nifty Bank finally take that leadership role? I mean, are there any indications that now perhaps is the right time? I mean, HDFC Bank was the top contributor for Nifty. Is that enough, or more needs to be seen for Nifty Bank to rally from here on?
Well, if you look at the two indices, if you compare them, as you rightly mentioned, Bank Nifty has been languishing. And if you look at the flow in the Bank Nifty, the flow has been evenly distributed with the private and the PSU banks. Some days it's the PSU bank which gets the share of the flow, and some day the momentum flow gets into the private banking space. So it's not a combo effort of the Bank Nifty which has moving in tandem to lift up the index. And my sense is that 52,000 basis spot Bank Nifty is a major hurdle for the next few trading sessions. And with the RBI policy due on 8th of August, this level would especially hold special relevance. Now, if the Bank Nifty does manage to get past 52,000, that's the first sense of momentum indicators giving a buy signal on the Bank Nifty, where you can see a Bank Nifty making a run for levels of 52,700 to 52,800, almost near the all-time high levels. So right now, as I see, it's more of a choppy trading session for the Bank Nifty. 52,000 on the upper end and 51,300 on the lower end is the range which is slowly building up. For a buy trader, I think let 52,000 break, take Bank Nifty trading in parts and parcels. It's because the trend has not yet been confirmed that it's going to be a very strong trending Bank Nifty in the month of August. So let 52,000 break. If it doesn't, then it will languish as it is in a trading range which I mentioned.
And Avinash, I mean, let's keep it with banks for now. Recently, RBI, pretty much announced that the bank deposits that are made through online channels, banks would need to keep a higher liquidity buffer. And, the gap between deposit and credit, the loans dispersed is already at a 20-year high. I mean, considering from what I understand, this particular move could further drive up the cost for banks, and because of which it could force banks to cut down their FD rates once again, which could exacerbate this entire problem of lack of deposit growth. What's your opinion over here, sir? Is RBI or the regulatory crackdown that we are seeing, is what impeding this growth in banks, or at least stocks in this segment to do well?
I think you're right. I think deposit growth rates would further get impacted, and I think the cost of raising funds will obviously increase in the in the short to medium term. And I think obviously once you need to make a bigger provision, that kind of liquidity will not be available for the banks. So I think the banks will have a challenge. I think most of the banks who have large CASA ratios also will obviously have to make these provisions. So I think net. Yes, banks are going to face a pretty challenging period. Either they cut down the FD rates, or possibly, they will have to recover this cost in some way from the customers. So I think net, both the PSU as well as private sector banks could get impacted. And I think, this could get reflected in maybe the September quarter numbers. The June quarter numbers may not show any, negativity on this front. But September quarter onwards, I think you'll see these kind of, margins getting compressed to a marginal extent. Larger banks, who have a large deposit base would obviously have to then reconsider, whether they cut FD rates or they obviously recover this cost via some other kind of, method.
All right, and let's also quickly take a look at sectoral performances. Gains were seen in Nifty Metal, Nifty IT. Let's get that chart back up. Nifty Private Bank, Oil, Gas, Nifty PSU. While Nifty Realty and Nifty Media suffered losses, they were impacted by profit booking. As far as broader markets is concerned, they closed on a negative bias due to escalating geopolitical tensions in the Middle East and the rising possibility of crude oil. It is believed that large cap stocks may see some increased investor sentiment, participation. Sudeep, would you agree with that? What's your recommendation for investors today?
Well, I've been, keeping on advising investors to focus on good quality stocks for some time, and I'll maintain that. Amongst the sectors, I like power sector. I think there is a secular bull run in the power space, and there are structural changes happening there. So leading power company like NTPC is a good buy, even at current levels for a long-term investor. The power financials, power ancillary companies, all are worth looking at if you are a long-term investor. Valuations have moved up, but even at these levels, they are interesting. The other space where we are positive is the FMCG. I think, the rural rejuvenation is real. We can see that in the numbers of Colgate, Palmolive, Dabur, who have announced results. And these companies have significant rural presence, 40% plus, and their numbers were good, particularly the rural sales pickup. So all rural focused FMCG companies should benefit over the next couple of quarters. We also have a positive view on another laggard sector, which is the specialty chemical space. The Chinese dumping and the issues relating to that is to an extent over. The demand in China is started to pick up again, and the stocks in China have to a great extent been liquidated. Apart from that, I think the original, the hypothesis of China plus one continues to remain valid. Under the circumstances, I think Indian specialty chemical companies will start seeing, return to profitable and, good quality growth in the near future. One has to be a little patient, but I think it's the right time to pick up these stocks at current levels.
All right, so that is, of course, Sudeep's pick. Avinash, right before we lost you, my question for you, for all the retail participants who are sitting out there on the fences, looking at markets heating up, is the market too overheated to enter at this point? What would your advice be?
I think, on the index level, the markets definitely seem to be expensive. But I think if you look at the broader market, I think there are many companies which have posted very strong Q1 numbers. The management commentaries have also been good. So I think clearly, investors should look at the broader market. I think the large caps and maybe the index stocks, have gone up significantly. And I think you have to pick and choose based on a stock specific approach. But yes, I think wherever the valuations are very expensive, where the business is not sustainable, I think it's better to book out your profit, because even penny stocks have now started moving up. And broadly, I think it's very difficult now to identify good stocks with which can generate a good alpha. But I think still within the cement space, capital goods space, or even the auto component space, there are many reasonably priced companies. If one were to look at. I think you need to take a slightly longer term view, and I think yes, you need to continuously book out profits also, because just sitting on paper profits has got no meaning. So you need to convert those paper profits into cash flow, and I think you need to ride the trend, because clearly with so much liquidity coming in the market, as Sudeep mentioned, SIPs have now averaged about 21,000 crores. LIC, insurance money is coming in the market. FI money is coming. A lot of AIF money is coming. So the market is unlikely to correct sharply. And I think if you wait for a deep correction, I think it's not going to come in so soon. So, liquidity is going to support the markets. I think you need to take that into account and obviously bet on those companies where the earnings growth is positive, and I think where the commentary is good. But I think you need to be very selective.
Okay,
right?
don't wait for the correction, I think, and
and,
that's the word coming in from experts. Don't sit on the fences when all the liquidity is coming into capital markets. It's perhaps time for you to also ride into that jubilation.
Certainly, and something that Avinash mentioned over here, that is getting very difficult to find good quality stocks, and we have a technical expert over here. Akshay, any pockets of opportunity that you see in this market that is, as far as valuations are concerned, overheated?
See, I'm looking at the FMCG pack because this last few days of rally has been more sectoral. It's about the money flow, chasing the sectors, and you have to be at the right sector at the right time if you are a short-term trader. Now, here, if you look at the FMCG sector, somehow this sector has gone a bit dull of late, and my sense is that the momentum should chase this sector very soon. So here, Hindustan Unilever is one stock you can consider. It closed around 2715. It has a very healthy price structure from a medium term chart perspective, and it is slowly building a base around the 2690 2700 area and setting itself up for launching the next round of momentum, which can easily see the stock getting past the 2800 mark. So HUL will be my first top pick. You can buy it at current market price tomorrow with a stop loss below 2650 for targets of 2800 and 2850. Another trade I would recommend here is United Spirits. Again, this stock has seen a very strong bout of momentum lately, and it's been going one way. It's been in a one-way rally lately. Just last 4 days have been a bit off. My sense is that the momentum should regain again in United Spirits as it currently reads, and the stock should be moving for its lifetime high. So consider buying this stock at the current market prices tomorrow. The approximate targets which I foresee is roughly around 1447 and 1464. Keep a stop loss of around 1375 on this long trade.
All right, I think that is as far as Akshay's stock pick is concerned. But before I close the show, Nifty crossing and breaching that 25,000 mark. It's a historic day for India. It came, of course, on the back of US FOMC hinting at a possibility of a rate cut in September. The dip in US bond yield may also is expected to either reverse or halt the FII sellings, and that could also have an impact on the Indian markets. But before that really happens, gentlemen, before I close the show, my quick question to you: what could be the biggest risks for capital markets today as you see it? Let's start with you, Sudeep.
Well, of course, geopolitical issues. I think the way the Middle East is getting embroiled in controversies and controversial killings and counter killings. I think it can flare up into a full-scale war, and that will be disastrous for a country like India, which has significant import dependence as far as crude oil is concerned. So crude oil going up is not in the interest of India. The last factor I'll mention is the monsoon. Though monsoon has been all right till now, but we need much more and we need better distribution. Let's wait and watch.
Right. Quickly, can I go to Avinash now? Avinash, 20 seconds. Sorry, we've run out of time. But quickly, what in your view could be the biggest risks for Indian markets today?
I think first is the geopolitical risk, which Sudeep mentioned, and the second is the regulator risk. I think if the regulator, imposes some severe kind of actions on the F&O side of the market, which I think a lot of discussion has already happened. I think that could also be a kind of spoke in the wheel, and I think that could upset the market sentiment, at least in the short term, because a lot of retail money has entered the derivatives market, and I think the regulator is very serious that they don't want retailers to get into this segment. So any kind of adverse negative surprise happening here could obviously affect volumes and obviously impact the market in the very near term.
Okay, Akshay?
Only the global concerns, as I understand. If there is any kind of fear getting in the system, keep a strong note on the volatility index. It is at 12.93, very stable right now. If it picks about 15, it is a reason to worry. Otherwise, all is well. Continue with the normal stability in the market as it is.
All right, all is well. All looks very well, and it's a historic day here for India, with Nifty breaching that crucial 25,000 mark, ending at about 25,010. And we will, of course, keep bringing you all those updates as far as capital markets is concerned here on Newsline Live. Gentlemen, thank you very much for taking time out. Thank you for joining us on this show. And with that, it's a wrap. Thank you for watching.